Hey everyone, welcome back to Corporate Decoder, the place where we break down the money moves of the biggest companies. And let me tell you, Zoetis Inc. has some interesting moves in their latest filing. This report is basically a yearly checkup for the company, and it's packed with details about how they did in 2025. And speaking of checkups, if you appreciate getting straight insights from these corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we talk more about these kinds of things. So Zoetis, they're a global leader in animal health, basically making medicines and vaccines for pets and farm animals. Think dogs, cats, horses, cattle, you name it. They've been around for a long time, almost 75 years, and they're all about keeping animals healthy. Pretty cool mission, right? Now, let's dive into the numbers. This filing is their big annual report, and it tells us how much money they made and what they spent it on throughout 2025. First up, the top line, their revenue. In 2025, Zoetis brought in a massive $467 million. That is about $9.5 billion. Compared to the previous year, 2024, that is a pretty solid increase of 2%. It might not sound like a lot, but when you are dealing with billions, even a small percentage means a lot of money. This revenue growth was helped by them being able to raise prices a bit, about 4%, and also selling a little more of their established products and key franchises. However, they did see a dip because they sold off some of their medicated feed additive business. So, while the overall revenue is up, it is important to remember that sale. Now, let's break down where that money came from. Zoetis splits its business into two main parts, the United States and international. In 2025, the US market was their biggest player, bringing in $5, Euro 97 million, which is 54% of their total revenue. The international side brought in $4, 254 million, making up 45%. It is interesting to see how their business is split almost down the middle between the US and the rest of the world. Within these regions, they also break down sales by whether it is for companion animals like pets or livestock like farm animals. For the US market, it's clear that pets are king, with 83% of revenue coming from companion animals and only 17% from livestock. But when you look internationally, it is a bit more balanced, with 56% from companion animals and 44% from livestock. This shows how different markets have different priorities. Now, this is where it gets really interesting. Zoetis has a few star products that really drive their business. Their top two product lines, Simparica Trio for flea and tick protection in dogs, and Apoquel Chewable for dog allergies, account for a huge chunk of their sales. Simparica pulled in about 16% of revenue, and Apoquel brought in 12%. That is a quarter of all their income from just two product families. Add in their next three biggest sellers, Cytopoint Librela and their Ceftio Fur line, and you are looking at 42% of total revenue coming from just 5 product lines. This dependence on a few big products is common in the pharmaceutical industry, but it also highlights a potential risk. If one of these products has an issue, it could really hurt the company. Looking at expenses, their cost of sales, which is what it cost them to make their products, went down a bit as a percentage of revenue. This is good news, meaning they're becoming more efficient in their manufacturing. They chalk this up to the sale of that medicated feed additive business, price increases, and some favourable foreign exchange rates. But it is not all sunshine. Their selling, general and administrative expenses, which include things like marketing and salaries, went up by 3%. This was mainly due to higher software costs, more charitable contributions, and increased professional fees. You know, it costs money to run a global operation. Research and development costs, the lifeblood of any innovative company, also saw a slight increase of 2%. They're investing more in new products and improvements, which is essential for their long-term growth strategy. Now, let's talk about debt. Zoetis has a pretty significant amount of debt, about $9.2 billion as of the end of 2025. This is a critical point to watch. While they have a lot of cash coming in, having that much debt can be risky. It means they have to make regular interest payments, and if their business slows down, it could become hard to manage. They did issue a lot of new debt in 2025, including $2 billion in convertible senior notes and $1.85 billion in new senior notes. They used some of this money to pay off older, more expensive debt, which is a smart move, but it also means they're juggling a lot of different debt obligations. The company also spent a lot of money buying back its own stock in 2025, about $3.2 billion worth. This is usually a sign that management believes the stock is a good investment. It can also boost the stock price by reducing the number of shares available. However, with all this debt and stock buybacks, you have to wonder about their cash flow management. Looking at their cash flow, they generated a solid amount of cash from their operations, about $2.9 billion in 2025. That is a slight decrease from the year before, but still a very healthy number. However, they used a lot of cash for investing in their business, like capital expenditures and even more for financing activities. mainly paying off debt and buying back stock. Now let's talk about risks. Zoetis operates in a highly competitive market. They face competition from other big animal health companies like Merck Animal Health and Elanco, as well as smaller players and even generic drug makers. They're also dealing with changing distribution channels, especially with more people buying pet products online and at big box stores instead of just through vets. Plus, there are always risks with product development, regulatory approvals, and potential recalls. They specifically mention risks around antibacterials in livestock and the growing concern about climate change's impact on their business and their customers. One really critical element in their report is their risk factors section. It is like a yearly confession of all the things that could go wrong. For example, they're heavily exposed to currency fluctuations because so much of their revenue is generated outside the US in 2025. About 42% of their revenue was in currencies other than the US dollar. That means if the dollar strengthens, their international earnings can look smaller when they convert them back. They also talk about cybersecurity. In today's world, that is a huge deal. They acknowledge they are reliant on complex information systems and are vulnerable to cyber attacks. Despite this, they say that so far these threats haven't materially affected them. They have a cybersecurity program in place, but it's definitely something to keep an eye on. Looking at their leadership, Kristen C. Peck remains as Chief Executive Officer. Whitney Joseph is the Chief Financial Officer. These are the key figures steering the ship. The rest of the executive team is responsible for different areas like manufacturing, commercial operations, and research and development. It is a pretty standard executive setup for a company of this size. In my opinion, Zoetis is in a strong position for now. They have a dominant share in a growing market, and their focus on innovation, particularly with products Simparica and Apoquel, is paying off. The revenue growth, even if modest, is consistent, and their cost management seems to be improving. However, the significant debt load is a concern. While they generate good operating cash flow, a substantial portion of that is being used for debt repayment and stock buybacks. What is really key here is how they manage their innovation pipeline and navigate the competitive landscape and increasing regulatory scrutiny. They need to keep bringing out new and improved products. Not just relying on their current blockbusters, the risk of generic competition is always present, and they need to be prepared. Also, their international diversification is a strength, but it also exposes them to currency risks and geopolitical uncertainties. Overall, Zoetis is a solid company, but investors should be aware of the leverage and the competitive pressures. That is our deep dive into Zoetis Inc.'s 2025 annual report. What do you think about their strategy and their financial health? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more content like this. And hey, don't forget to join our Discord community to keep the conversation going. Thanks for watching, and we'll see you in the next video.